Hey everyone, welcome back to Corporate Decoder, the place where we untangle the world of finance and corporate filings. Kind of like trying to find a needle in a haystack, but instead of hay, it is super technical jargon, and we're here to find the treasure. In this video, we're diving into Spade Acquisition, the third co's latest SEC filing now. This isn't your typical company with a bustling factory or a popular app. This is a special purpose acquisition company, or SPAC. Think of them as a shell company with a pile of cash looking for another company to buy. It is like a treasure hunt for a business, but today, we're not just looking for the treasure, we're decoding the treasure map, which is this filing. Before we dive in, if you appreciate getting straight insights from corporate documents like this, make sure you are subscribed. We also have a Discord community linked in the description below. It is a great place to connect with other corporate finance enthusiasts and get more direct access to our analysis. Spade Acquisition, the third co, is a blank check company, meaning it was formed specifically to raise money for the purpose of acquiring another business. They have not yet identified a target company for this acquisition. Their goal is to find a business to merge with, and they've given themselves 24 months or sometimes 27 months to do it. If they don't find a suitable business within that time frame, they promise to give all the money raised back to their investors. For this offering, Spade Acquisition, the third co, is aiming to raise $150 million by selling units. Each unit contains one Class A ordinary share and 1/3 of a redeemable warrant. A warrant gives the holder the right to buy a share in the future at a set price. They are also selling an additional 25,000 units to cover over allotments, which means they could raise even more if demand is high. Now, let's talk about the people behind this SPAC. Their sponsor, Spade sponsor, the Throod, has bought 5 million founder shares for a tiny price of $25,000. That is about $0.004 per S-hair. This immediately tells us that the public shareholders are going to experience some dilution, meaning their ownership stake will be smaller compared to the founders. Especially if a business combination is successful. Scroll 5750000P. The plan is to sell 15 million units, which would give them $150 million in proceeds. Out of this, $150 million will go into a trust account, which is essentially a safe place for the money until a business combination is found. The rest, about $1.1 million, will be used for operational costs and searching for that target business. Because they are not operating yet, their financial statements are pretty simple. As of the 5th of September 2025, they had a net loss of just over $17,000, which is basically just the cost of setting up the company. Their total assets are a modest $75,000, mostly in prepaid expenses and deferred offering costs. Liabilities are also pretty low, mainly accrued expenses and a small promissory note to their sponsor. Their total shareholders' equity is a mere $7,694. This shows they are in the very early stages, still building the foundation before any real business activity begins. Now, let's look at the dilution. If you buy a unit at $10, your net tangible book value per S-hair after this offering could be as low as $0.18 in a maximum redemption scenario. That is a significant drop, showing how much the founder shares and warrants can impact the value for public investors. The difference between the $10 offering price and the pro forma net tangible book value of around $0.18 per S-hair represents the dilution. And speaking of risks, there are plenty for a SPAC. They have to find a business and complete a deal within a limited time. Failure to do so means investors get their money back, and the warrants expire worthless. They also face competition from many other SPACs and investment firms. Plus, the complexity of laws, especially if they acquire a Chinese company, adds another layer of risk. Given that their sponsor and management have strong ties to Hong Kong and potentially China, there is a whole section dedicated to the risks of dealing with Chinese regulations. Things like data security laws, foreign investment restrictions, and potential government intervention could seriously impact their target business, and by extension, your investment. This is a pretty big red flag to consider if you are thinking about investing. The company's sponsor, Spade sponsor Lev III, has committed to purchasing a significant number of private placement warrants. These warrants have terms that are similar to the public warrants, but with some key differences, like not being redeemable by the company and having restrictions on when they can be sold. This aligns the sponsor's interests with the company's success, but also introduces potential conflicts of interest since they pay a much lower price for these securities. Another thing to note is that the company is incorporated in the Cayman Islands. This means Cayman law governs them. While this offers certain tax advantages, it can make it harder for us investors to protect their rights or enforce judgments from US courts against the company or its directors. The report goes into detail about how Cayman Islands law differs from US law regarding shareholder rights and mergers, which is important to understand if you are considering investing. The warrants themselves can also be a double-edged sword. While they offer potential upside, they also create dilution. The company can redeem these warrants under certain conditions, which might force you to exercise them at a time that is not ideal for you, potentially making them worthless. Plus, the structure of the units with only 1/3 of a warrant per share is a bit unusual and might mean they're worth less than units from other SPACs. Now, let's wrap this up with our take on Spade acquisition through company on the financial side. It is a SPAC, so financials are thin at this stage. Net loss is minimal, mainly startup costs. The real story here is the potential dilution for public shareholders due to the sponsor's cheap founder shares and warrants. The company is essentially betting that its experienced management team can find a great business to buy and grow, justifying the initial investment despite the dilution. The strategy focuses on entertainment, leisure, and digital financial infrastructure, areas where their sponsor, Lawrence Ho, has deep ties and proven success. This focus is a strength, leveraging their network. However, the significant risks tied to potential Chinese investments are a major concern, as highlighted throughout the filing. The legal and regulatory landscape in China is complex and unpredictable, and any issues there could be a significant blow. The biggest risk right now is time. They have a limited window to find a business combination. If they don't, investors get their money back, but those warrants worthless. Warren Buffett would likely look at this and say, high risk, high reward, but understand exactly where that risk lies before placing your bet. The potential for profit for the sponsor, even if the stock price tanks after a deal, is substantial, which is common in SPACs, but always worth noting as a potential conflict of interest. Alright, that is our breakdown of Spade acquisition 3Co's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think the management team's experience outweighs the risks? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate finance. And don't forget to check out the Discord in the description to join the conversation. Thanks for watching. See you next time.